we've been looking at a lot of stocks that have been doing extremely well. One stock that was up over 1,000% recently, been all over the news, is GameStop. GameStop in the last 3 months is up over 477%. At one point, it was as high as $500. We've been seeing all about the massive short squeeze in the news. How is it crashing? Is it over? What's happening? But it looks like GameStop could potentially be rebounding a bit. Just the other day, GameStop was up 20% during hours, and after hours, it was up another 4.5%. So we may be seeing a little rebound here, and we'll have to wait and see what happens. But the impact of GameStop on the long term, on the stock market, on regulations, and potentially seeing another short squeeze with other stocks, the impact of GameStop long term is really going to mean we're probably going to see a lot more bubbles that appear very quickly in either small cap stocks and, pretty much the smaller cap stocks. I think we're going to see a lot more bubbles. There's going to be a lot less shorting. We've already heard from Citron Research and other big institutions that they're not going to be putting out short reports, that they're shorting a stock anymore. Because what happens is, like, when a company like Citron now goes ahead, puts out a report that they are bearish on a stock, they're going to short it. Well, then what that does is, it used to be like a self-fulfilling prophecy that a large institution would say, this stock is bad, we're going to be shorting it. Then everyone else would say, oh no, this company doesn't look good right now, we need to sell it, we need to get out. And that would just cause the stock price to go down. But now what's happening is, like, these large banks are saying this stock is bad, and people are saying, let's buy it. So then we're going to, get back at the large institutions. We're going to screw them, because if we buy it a lot, well, then these large institutions are going to lose a lot of money. So it's really the complete opposite of what used to happen is now happening. And that's going to lead a lot of large institutions to just not tell people when they're shorting stocks, or just lead them to not short the stocks in general. And this could have some negative effects, actually, on the stock market, according to a couple of researchers. According to researchers, they say that bubbles tend to be less common in countries where short sellers are less restricted, because they said that essentially when short sellers, release these reports, there's more pessimism in the market, and that can balance out some of the optimism about a certain sector or a stock. So it really prevents people from getting too high or too low about a stock, really forces people to look at it more realistically. In addition to that, researchers say that in this sort of market right now, where we're seeing valuations at record highs, even with the pandemic going on, they say that we need to have short seller views now more than ever, because normally short sellers are looking for companies that are overvalued. They're always on the lookout for fraud, things that don't look right in large companies, publicly traded companies. But now, with all of the stuff that went on with GameStop, shorting stocks, we're not going to see this as much, and that could be bad for the market, because the market needs to have, according to these researchers, it needs to have companies looking out for stocks that are overvalued, companies that they think something is going on that doesn't look right. And if large institutions aren't going to be shorting stocks as much, we're going to miss that. We're not going to have that anymore in the market. In addition to this, they also go on to talk about how we're going to see a lot more bubbles. So with GameStop, we saw WallStreetBets, their user base rose from less than 2 million people to over 8.5 million people on WallStreetBets. And there's a lot more retail investors that got into the stock market looking and are interested in putting money in. Some of them are looking at it almost as like a game, like gambling. Other people are getting in for long-term investing, but we saw a lot more people. And with everything that we saw with WallStreetBets and GameStop, a lot of people expect to see many more bubbles in the future. We saw it with AMC, Naked Brands, Blackberry. We saw it with Nokia. We saw it with a lot more stocks, and they expect that we'll continue to see this long term, and it may lead to a lot of people losing a lot of money, because they're going to get in blindly to all these stocks that are going up, and they're going to come crashing down, and people are going to lose a lot of money. So you have to make sure to be careful investing in companies that you think are good long-term, stocks that you think actually have a long-term future, have a business model that is profitable or is trying to become profitable and not just follow the hype. The hype is good when you're making money, but all those stocks are going to come crashing back down eventually, and you just have to be aware of the impact of GameStop on companies now seeing stocks rise 300% in a day when there's no reason for it. So you just have to be careful with that.